Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Massar and Tim Stenivek on Bloomberg Radio.
All right, time to talk about the world of technology, because we had kind of an amazing visual yesterday at the White House. Meta Platforms' Mark Zuckerberg, Apple's Tim Cook joining tech industry leaders in touting their pledges to boost spending in the United States on artificial intelligence. It was all during a dinner hosted by President Donald Trump that highlighted his deepening relationship with Silicon Valley. The execs making comments at the dinner, among them Apple's Cook, here in exchange with President Trump.
We are all different in some ways, but we all believe in the power of technology to improve people's lives, and that is the thing that binds us all together.
And Tim, how much money will Apple be investing in the United States? Because I know it's a very lot, and it's, you were elsewhere, and now you're really coming home in a big way. How much money will you be investing?
$600 billion.
$600 billion, all right. It's a lot of jobs.
We're very proud to do it.
That's great. Thank you very much.
Thank you.
Appreciate it.
Thank you, sir.
All right, Apple CEO Tim Cook last night at a dinner at the White House, along with other big tech leaders. Of course, you heard President Trump there. And Tim, that eye-popping image of those CEOs at the dinner. We also had an eye-popping story about Elon Musk as well. There's like a lot going on here.
Yeah. Okay. So let's talk about this. And with somebody who knows all about it, we've got Ed Ludlow with us. He's co-host of Bloomberg Technology on Bloomberg Television, Monday through Friday, 11 a.m. Wall Street time. Check it out. Ed joins us from the Bloomberg News Bureau in San Francisco. First up, Ed, that meeting of tech CEOs. You had Tim Cook there. You had Mark Zuckerberg there. Sam Altman, Sundar Pichai, Sergey Brin, Satya Nadella, Bill Gates. Even members of the Trump administration who previously worked in technology or in venture capital, David Sachs, for example. What was the image that this portrayed of the relationship that Silicon Valley or technology or the biggest companies in the world has with the White House?
Well, there was another piece of news that came out with it, which is almost another quid pro quo, right? In that clip, you heard President Trump asking Tim Cook, the Apple CEO, how much are you going to invest, Tim? Oh, $600 billion. And the same was put to Mark Zuckerberg, who also said $600 billion. But the background comment the president had made is that tariffs for semiconductors specifically are coming. And it's those that have pledged to invest in the country that will be spared from them. That's why we look at it a little bit like a quid pro quo. But AI is at the heart of this administration's platform, right? Deregulating to allow for faster building of data centers. And those people around the table, bar a few exceptions, and missing people, those are the names that are leading on that front.
Yeah, it's interesting. It's funny. Tim and I were talking kind of before going, because it's kind of a little bit remarkable to see these images. And I think there's at times been a love-hate relationship between the White House and Silicon Valley. What?
I was surprised to see Jared Isaacman on the list, Ed, because he was supposed to be administrator of NASA. He's of Shift4 Payments, of course, somebody you've talked to and you know pretty well. What's good? The president pulled his name from the list and pulled his nomination. Well, why was he there?
I think it's important to tell the truth. I don't know why he was there. In chatting with Jared recently, I don't know that he's worked out what his next thing is going to be. On social media, which is a dangerous place sometimes, a lot of people would have observed that Elon Musk was not at the table. Mm-hmm. But they would say, oh, who was there representing Elon Musk? Surely it was not Jared Isaacman, because of the situation you just explained, and there were other people there at the table who also have connections to Musk. But yeah, I promise you that when next I speak to him, I will ask him specifically, how'd you end up at that table given the president's recent handling of your nomination?
On the Elon Musk thing, he was asked about this on social media. He replied to somebody and said, I'm not able to make it, but I will have somebody represent me.
That's what I'm alluding to, yeah.
I'm looking at the list right now.
Is that it?
I don't see a representative from Tesla or from SpaceX there.
Yep. I think that we're just going to have to let the reporting be done.
Okay.
And if we still care, we will confirm who Elon's representative at that table was on the night, but we don't know.
Does he really care? Because, I don't know, he might get a compensation package worth about $1 trillion. So is it really that important anymore? What do we know about this?
Yeah, I think, it's been a very long day reading a 300-page document, and there's so much detail in it. The simplest way of putting it is $1 trillion after 10 years if a very large number and sequenced series of events take place. Tesla and Musk have to meet many operational and financial milestones for the full trillion to be realized. And there are many other safeguards and securities from Tesla and Tesla shareholder standpoint baked into the proposal that would keep Musk focused on the task at hand. We can get into them, but for example, in order to access the last 2 tranches of stock, Musk has to pay for them up front, almost like an option's being exercised at the price that the shares closed September 1st, but he also has to participate and sign off on the succession plan. So he has to work on his own successor in year 8, 9, and 10 in order to get to not just the reward from money, right? We're not talking just about compensation, but in his case, he wanted the voting rights as well. And they're staggered over that 10 years.
So who is this a win-win for? And I only ask because Tom Maloney has also put out a story of Bloomberg News and says that Elon Musk got this $1 trillion with genuine threats to quit Tesla. So was the company really worried about losing Elon? So was he in the driver's seat on this? Because this package sounds like there are some guardrails around Elon in a big way.
Yes, Tom Maloney has reported it beautifully. If you don't read the full 300-page proxy, read Tom's report. The committee representing the board met with Elon Musk 10 times in negotiation of this package. They delayed the annual shareholder meeting as they negotiated this package. They hired a number of outside firms and advisors to get the package at least over the line. I say over the line, it still has to be voted on by shareholders in November. Musk's point was, if you do not give me this voting power of 25% or greater, I will go and do the things that I'm interested in elsewhere, XAI, SpaceX, etc. What did the board get in return? Section A51 or page A51 of the proxy, point number 2. We have got reassurances from Elon Musk that he will wind down his political activity. So it's not a sort of blanket all going to Elon. The board has made, including with the operational goals they've set for Elon, these are really hard. They've got things to protect them in making sure Elon Musk is focused at the same time.
Yeah, $8.5 trillion in market cap from $1.1 trillion today, Ed. How does Tesla get there over the next 10 years?
Yes, so Tesla has a market cap today of about $1 trillion, and one of the financial milestones for Elon to realize the full $1 trillion of comp is for it to get to $8.5 trillion. It's very interesting when you set that against the operational goals. The operational goals are very much in line with AI. Grow a robotaxi fleet to 1 million units. Robotaxis, 1 million, taking people on ride-sharing platform. 1 million humanoid robots. But the board also tucked in there a goal for Elon Musk to sell 20 million Tesla vehicles total and deliver them to consumers. And it shows that the board fought to keep Elon Musk focused on Tesla's bread and butter business, even in the likelihood that that $8.5 trillion value in the long run is more closely aligned to the big robotics and AI stuff than it is in the now archaic business of building vehicles and selling them to consumers. That's kind of how I think the market looks at it.
God, that's massive. Are we even crazy to think about an $8.5 trillion market cap for Tesla?
When I first moved to California in 2018, which ain't that long ago, right? NVIDIA was a company that made GPUs for video game developers and went into high-end consoles and computers for video games. It was a few $100 billion. It's now a $4 trillion market cap company. It's the easiest example for me to cite over a period of less than 10 years of a company dumping in trillions of dollars of value.
Can I just ask you why all this stuff about Elon's compensation is happening now? Is it just they were having meetings and it's all coming out? Is there anything about the time or what?
Well, a proxy needs to be filed in advance of an annual shareholder meeting, right? Okay. And the annual shareholder meeting has to happen at some point. It's happening in November. So there's a chronology to it and the auditors have to prepare it. That's quite boring, but that's part of the answer.
One of the things we need to ask, too, is that the shareholders are going to decide, too, if Tesla should invest in his AI startup XAI. Significant?
Yes.
I mean, it does feel like Elon's rolling everything into one, or wants to.
This is a shareholder-initiated proposal. Many shareholders tried to get the proposal on the docket. In the end, they went with just one by a single retail shareholder. XAI, you could use Grok. I used it this morning, a voice assistant-based chatbot in Tesla vehicles. Bigger picture, XAI has a very different model to, say, Anthropic and OpenAI. Despite all the headlines about all the money those two AI startups have, OpenAI and Anthropic, they basically lease the data center capacity. They don't own the assets outright. XAI does. It's committing tens of billions of dollars to buy the GPUs and put them in a data center. So, the rationale is that there's synergies, that the work XAI is doing on software can benefit Tesla owners and Tesla vehicles. But it's also a bit of a lifeline. And if you allow me to do the plug, I'm going to write about this in my newsletter and column on Monday, because, that's the thing that shareholders also have to face. Does XAI on paper have the ability to stand on its own 2 feet? Or is this going beyond an investment by Tesla? Or is it a bailout of one Elon Musk company of another?
And just in the last 40 seconds, to push back on this a little bit, as Mark Gurman has told us, some of the LLMs and the tech, there's a concern that this could be a bit of a commodity.
Correct. And also the benchmarking figures for Grok 4 are very good. But again, it's a business model based thing. Elon Musk is committed to moving super quick, committing capital to buying GPUs, and the model's completely different. Again, it is not a binding proposal. It is a shareholder-initiated one. And if it's successfully passed in November, then the board needs to look at it and decide if it is a prudent and beneficial thing to Tesla to make that investment. But as I reported earlier in the year, SpaceX has put $2 billion into XAI.
Right.
So why not Tesla?
Oh, and by the way, Ed, you can promote anything you want on our air. You're Ed Ludlow. All right, we're looking forward to the newsletter. Shares of Tesla, by the way, up almost 4%. Ed Ludlow, co-host of Bloomberg Technology.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
All right, we want to get to what is really our top story on this Friday. And there's a lot going on, but we have seen some coolness in the U.S. labor market as a result of that data point we got at 8:31.
Well, it depends. It depends.
This morning.
I think we were pretty on time with it. We got a notice, though, just ahead of that number that there were some technical difficulties. That's something that is kind of new to me.
It's definitely new to me as well. It's not the only time, but I think
this was on the government side, by the way, not on the
not on the Bloomberg side.
Not on the Bloomberg side.
It definitely, though, did mean a new narrative and reset when it comes to U.S. rates. Let's get to that part of the story. Bloomberg Intelligence Chief U.S. Interest Rate Strategist Ira Jersey with us from New Jersey. Ira, just the whole morning and how it played out. Unusual? What was top of mind for you there?
Well, it was kind of funny, right? We got all those information that around 10 minutes after 8 that, hey, the number might be delayed. That's happened before. It's been a long time, but it has happened before that you've had delayed numbers because websites break, things like that. So I think they were teeing us up for it being late, and then we ultimately got it right on time, which was a little interesting.
Yeah.
But yeah, weak numbers across the board. You look at the revisions. June, we actually had job losses in the non-farm payroll series, right? We haven't had one of those for quite a long time. And you just see job momentum has slowed so significantly over the last 4 or 5 months that it's a foregone conclusion at this point that the Fed's going to cut. Now, the question is, and I keep on reminding myself, last year we said the same thing. I said the Fed's going to cut rates. They're probably going to cut 100 basis points, but it's going to be over 4 meetings. Wound up, they did a 50 basis point cut in September. That's some of the talk that I'm hearing from investors right now. that, they're wondering, hey, is the Fed going to cut 50? I do think personally the bar is pretty high for the Fed to cut 50 in September. But we get a week CPI report, and maybe they do. The chances, I think, of a weak CPI report are pretty low, though. So 25 basis points is done. Now the question is October, December, January, March, and then do they go more? And that's where I think we need to start focusing on, is that terminal rate. How far are they going to cut to? Are they going to go to only 3%, or are they going to go to like 2.5%?
The criticism from the Trump administration for months on Jay Powell has been that he has been too late, that the Federal Reserve has been too late. Is the president vindicated with a report such as this?
Well, maybe one meeting, quite frankly, because if you look at the preponderance of data that was coming in the first half of the year, right through the May numbers altogether, they really weren't bad, right? And so inflation still remains stubbornly high and above the Fed's 2% target. So the question always becomes, the Fed has a dual mandate. Do they care more about the employment part of their mandate, or do they care more about the inflation part of their mandate? And I think at this point they can say employment's what's important, because if the employment situation stays where it is, so very weak but not disastrous, or weakens further, right? So you start to get negative payroll prints, wages start to come down. You did see wages. That what worries me about this report more than even the payroll number was the fact that wages started to moderate. That's super important. But now you're at the point where, okay, look, if the job market gets really bad, we don't have to worry about inflation because prices are going to come down anyway because consumption is going to go down. So I think that now it's clear and obvious that they have to start cutting interest rates. Wasn't so clear in June. August, or the July meeting, you could argue maybe they could have cut. But I think that if I'm a Fed governor, if I were in their seat, June, I probably wouldn't have been cutting personally.
Well, one thing they certainly want to avoid is any kind of stagflation. Constance Hunter is with us as well, chief economist at EIU, the Economist Intelligence Unit, here in our studio, going to join in on this discussion. I saw you nodding your head a couple times. Jump in on what we got this morning.
So, if we look at that headline number, 22,000 looks really weak when we think about what would be replacement rate historically. However, as Powell talked about in his Jackson Hole speech, right, we have a decline in supply, that is the decline in the amount of people that are in the labor force, and a decline in demand. So that decline in the supply, which is now growing at like 0.2% year over year, if we sort of smooth it a little bit for 3 months, right? That is the denominator in the unemployment rate. And this is really, really important. We could keep growing at this pace. Unemployment rate's going to stay about where it is. So but as Ira was saying, consumption's going to weaken, because if you think about jobs growth, that's one of the things that feeds consumption growth. So there's a feedback loop where this slows consumption, slows demand, slows growth, and they're going to need to cut just to maintain that 4.2, 4.3% unemployment rate. But they probably need to cut a lot less than the market is thinking, given this shrinkage in supply. And if you ask me, that's what caused the big turnaround in equities today. People dug into the details of this number and realized, wait a minute, because of this shrinking supply, they might not need to cut as much.
So what does that mean to you? 25 basis points in September, and then that's it until 2026?
Oh, I think it's hard to know the exact timing. We think at least another 3 cuts over the next 6 months. It's going to depend on how sticky inflation is. What we've seen in core services, that's been remarkably sticky. So we're not even talking about the goods sector where we're seeing price increases, but everybody anticipates, dare I say it is going to be transitory. But the dirty word in economics, but it's that core good stickiness that I think if I were a Fed governor or a voter on the FOMC, that would keep me up at night.
Ira, is Jay Powell, though, feeling incredible pressure right now?
I don't know. I'm not sure if he, I can't get into his head, right? Because I met Chair Powell a couple of times, but mostly in passing at events. But I would imagine that the Federal Reserve is trying to be as neutral as they can, and trying to look past a lot of the rhetoric coming out of the White House. You can't completely ignore it, right? For sure. But you look at Secretary Bessent, and if you look at his Wall Street Journal op-ed, which Mike just talked about with
Austin Goolsbee.
With Austin. Yeah, they were talking about in there. There's some, I think, legitimate criticisms of what the Federal Reserve's done over the past 15 years, but it also misses some of the reasons why the Fed did some of those things over the last 15 years. Yes, the government should be, doing things from the fiscal side that, back during 2007, 2008, we were waiting for Congress to do something. Congress didn't do anything. So the Fed had to step in because there was no action out of Washington. Right. So, should the Treasury Secretary be more involved? Sure. Yeah, absolutely. Congress should maybe give the Treasury Secretary additional powers in times of financial emergencies and financial shocks to try and stabilize those so the Fed doesn't have to. Right. So there and some of those were built into some of the reforms that have happened over the last few years. So it's not exactly I agree with some of what Secretary Bessent said, and then other parts I think are much more nuanced. But nonetheless, like Fed reform, the Federal Reserve has not been seriously reformed for many decades at this point. And the world's changed, right? The financial world's changed. The markets have changed. So maybe there needs to be some type of, shift. Now, should it be a complete overhaul? I don't think so. But
right.
Could there be, nuanced changes that Congress considers? Sure.
All right. One thing I want to get to, you mentioned Secretary Bessent, another key member of the president's cabinet, joined Bloomberg Surveillance this morning. We're talking about the Commerce Secretary, Howard Lutnick. He addressed reliability of the data coming out of the Labor Department. Here's what he had to say to our team.
It makes it crystal clear you should have fired the person who was running that group, right? Because if you didn't fire him 2 weeks ago, you sure as heck would be firing him today. So they need new leadership in BLS, that's for sure. They need new tech in BLS, that's for sure. And Donald Trump needs to rely upon the numbers. America needs to rely upon the numbers. You can't have these bent former administration people who have a view and who want to harm the president. We need accurate numbers coming from BLS, and finally we'll have new leadership to deliver. You fire the person, what do you learn? You learn that their technology is just, oh boy. But we'll fix it. We'll fix it.
That was, of course, U.S. Commerce Secretary Howard Lutnick this morning on Bloomberg Surveillance. Mind you, he does not oversee the Labor Department. He is head of the Commerce Department. But what we care about, Constance, is U.S. data, economic data, has been the gold standard. Is the data coming out of these departments still reliable?
Yes, I think it is. I think it's going to take. Yes, it's still reliable. And the person, by the way, who is the acting secretary, Bill Wojciechowski, he has been acting secretary in the past. He has been there a number of times. This glitch that we had, while worrisome and concerning, but is not unusual in a world of technology. Who amongst us has not experienced technology glitches? Mm-hmm. I'm not saying it's acceptable or that we need to not have a very high standard, but I think that is the wrong thing to attach to. And if we look at the individual who's currently leading BLS, he has had this role in the past and there have been no problems or complaints. So it is a very robust system of the way we collect data. It's very robust in how we follow up with revisions. And the reason we have the revisions we have is because we want a timely read. That timely read is 90% directionally correct, right? And so it's valuable.
Yeah. Well, and I'm glad you went to revisions. I've only got about 30, 40 seconds left here. I mean, we are going to get a bunch of revisions next week, which will maybe show what about the U.S. labor market? Will our narrative change again? Just quickly.
No, it's still going to show probably some weakness because a lot of these revisions tend to be pro-cyclical. So as the market turns and the economy turns and gets weaker, then you wind up with weaker revisions, and then vice versa as well, right? Where you get upward revisions when the market's turned upward. But I agree. Like, I think generally speaking, the data that we receive is of reasonably high quality. The challenge is that the way that we collect data now has to be different because, again, the world's changed. Mm-hmm. And Mr. Lutnick does produce, his agency does produce a significant amount of data, like the Bureau of Economic Analysis, GDP data, the PCE report, all of those types of numbers come out of Commerce.
Let's not forget that. Folks, thank you so much. Great analysis on what we got early this morning and still continues to impact the trade. Ira Jersey, Chief U.S. Interest Rate Strategist at Bloomberg Intelligence, and Constance Hunter joining us right here in studio. She, of course, is Chief Economist at the EIU.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
This is the Bloomberg Businessweek Daily podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Of course, a lot of focus on the jobs print. It's been a lot about the big miss when it comes to non-farm payrolls, increasing just 22,000 in August. Revisions also showing on the employment shrank in June for the first time since 2020. Yet a deeper look into the stats show that women's participation in the labor force is also declining. In fact, as of last month, hitting the lowest since December of 2023. Misty Hegenes watches these stats and one's not from the BLS very closely. She's associate professor and associate research scientist at the Institute for Policy and Social Research at the University of Kansas. She's also a former principal economist at the U.S. Census Bureau. She's the author of a forthcoming book. It's out in January called Swiftonomics: How Women Mastermind and Redefine Our Economy. Professor, good to have you on the program. I know you weren't surprised to see participation fall for women because, as you found, working moms with kids are leaving their jobs in this economy. It's something we talked a lot about during the pandemic, but that seemed to reverse in recent years. Why is this happening again now?
Yeah, thanks so much for having me, Tim. There's a lot of reasons why it might be happening now. I was just looking at the numbers that came out in August for women aged 20 plus, and this, past August, we had 2 million fewer women aged 20 plus in the labor force compared to August of the previous year. So there's a lot going on with women where it's becoming very challenging for them to stay engaged in the labor market, to continue working. When you think about the environment that we're in 2025, all of the return to office, all of the federal government rifts, all of those types of policy decisions that we made early on in 2025 appear to be negatively affecting women.
Why is this happening now?
It's a great question. And, again, I think we need to think just about policies in general. Across institutions. We need to look at how employers are engaging with employees, the type of protections that they're offering employees. When the environment in work becomes really inhospitable to the way in which we live our lives today, there are a lot of caregivers who are just going to leave the labor market either out of force because they can't make it work or out of choice because it's just too exhausting.
What are the specific policies that are pushing women out of the labor force? Is it policies at offices like return 5 days a week, for example, or clamp down on hybrid work, or is it coming from the government? What can you cite specifically here?
Well, the one thing that I'll say is the government is a leader. Generally. And so businesses usually look to the way in which the government is structuring its policies around, its HR policies and policies around employment. And so when the government requires everybody to come back to work 5 days a week, private business employers follow suit. And, a lot of the rhetoric in early 2025 was really focused on telling employees that they were going to have to return to office. There's still a lot of businesses who haven't actually fully started that process, but just the fear of knowing that it's coming and your employer telling you that it's coming, means that there's a lot of women out there and a lot of caregivers who are going to adjust even before it actually comes into full effect.
The sad part is, while we did feel like we had some gains coming off of COVID, we did have some gains coming off of COVID. It does feel like these are problems that we have been talking about for a really long time, Misty. And I don't know, it's a bigger rethink in our society to value women, childcare. There's like a bigger thing that it feels like needs to be at play here.
100%. One of the things that gives me hope in all of this environment is we actually know now what it takes to really, get women back into the labor market. I think the pandemic really showed us that when we do, that employers, it is possible for employers to allow for flexibility and, the roof isn't going to cave in. They will still be productive. They will still be able to produce, the goods and services that they're producing. And now it's just a matter of choice. So we intentionally in early 2025 made a choice that we were going to restrict a lot of these flexibilities. And we have seen now what has happened. And the flip side of that, which maybe could give us some sort of positive reframing is that we know how to fix it. So if we want women's, labor force participation to go up again, we need to look seriously at, providing a work environment that isn't hostile to family life. Yeah.
Well, I'm wondering about the book that you have coming out in a few months and the research that you did for the book, specifically the type of work that's not necessarily measured by official data, the stuff that does disproportionately fall on women. I mean, we're talking childcare, household work, oftentimes falling on women in the house. How do you quantify that?
Yeah. So, the book is coming out in January. And also, I've developed a dashboard of statistics, of economic statistics all around care and caregiving. You can find it at thecareboard.org. And the statistics that we've developed there, we basically said, okay, if we went back to 1940s and instead of having, older white men who tend to have lots of care privilege, and by care privilege, I mean they have other people cooking their meals for them, ironing their clothes, etc. If instead in 1940s, economic statistics had been developed by caregivers, what would they look like? And that's what the Care Board is. And it's incorporating the amount of time caregivers spend in unpaid domestic load and domestic activities for their families. So cooking meals, washing clothes, all of these type of activities, we count up all the hours that caregivers spend in those activities, and then we put a price tag on it. And then we fold that in to some of the economic statistics that we all are very familiar with, like labor force participation,
right. I mean,
GDP, et cetera.
It's so funny. I was talking to somebody about the growth of economics and business news, and just like this concept that there really is a monetary value to everything that goes on in our world. And it's how we value things. And it just shows how much we don't really necessarily value caregivers and so on and so forth. And until that changes and we put a value on it, it's hard to get policy to change. Listen, I don't know. What's the government's role that needs to be maybe more aggressive in this to help us out?
Yeah, I mean, I think it would be great if, the government were to, create some sort of official statistics around economic productivity and growth that incorporated the value of some of these activities. The VEA does produce a satellite GDP estimate, which incorporates household production, like cooking meals at home. So we're moving in the right direction, but we still, there needs to be more awareness. We need to, really start thinking seriously about this. And one of the other reasons why we need to start thinking seriously about this is just because of the high levels of educational attainment that women have these days. High levels of education mean that women are focused more on having a career versus having a job. And that, ties in more strongly to personal identity. It makes it more difficult when women are trying to think about, do I start a family or do I continue down my career path? And if we can't figure this out of how to make the workforce less, hostile to this idea of wanting to have a career and having a family, it's only employers, it's only the economy, it's only all of us writ large who are going to lose out from that.
We're just not going to get married and have kids. That's it, guys.
Well, that's bad for the economy. That's bad for the economy.
Just gonna say.
Hey, just in 10 seconds, is there a country that's doing this really well around the world in your view?
Well, I think a lot of the Scandinavian countries do actually have quite a robust system of social policies that, provide affordable and high quality daycare, that encourage fathers to also take, parental leave. So there are examples in some of the Nordic countries.
All right, got to run. Misty, thanks so much. Misty Hegenes, Associate Professor and Associate Research Scientist, Institute for Policy and Social Research at the University of Kansas. She's got a new book coming out, comes out in January, Swifty-nomics. Love it, love it.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
I'm driving in my car.
How about you let me drive?
Oh, no. This is not a toy.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, everybody, TikTok, just about 18 minutes to go until we wrap up the trade for the Friday session. Also, the week overall. It was a shortened holiday week. It didn't feel that way, did it?
No, it wasn't yet a shortened holiday week. It is still a shortened holiday week because we are still here, my friend.
We are. All right. So too is Louis Navalier back with us, Chairman, Founder, CIO of Navalier and Associates, joining us from Manalapan, Florida. How are you?
Good.
Good. Short and sweet.
And that's it. That's all the time we have for you today, Louis.
Listen, we saw stocks actually moving up earlier, but they've been down for most of the day. Are investors more worried about an economic slowdown rather than being enthused perhaps about rate cuts?
No, I just think it's a Friday and people like to clean out their inventory before the weekend. Fridays are seasonally weak, especially in the late hours, especially if the weather's good. Everybody has to go to the U.S. Open or something like that,
Wait, is it that simple? Really? You're thinking it's just that? It's just clearing out on a Friday?
Pretty much. Mm-hmm.
Alcaraz is up 2-1 over Djokovic, but Djokovic is up.
All right.
Advantage Alcaraz.
Now I know where your focal points are.
Hey, Louis brought it up. I got to mention the score.
Well, Louis, to some extent, would you not be making any big bets until we get through the Fed meeting, or did the jobs report, did that kind of clinch it for you? Help me out here.
Oh, it more than clinched it. I mean, it's obviously the Fed should have cut in June. And that downward revision to June to a negative number for the first time in 4 years was a big deal. Unemployment being at the highest rate in 4 years is a big deal, even though I think 426,000 entered the workforce. So, it was a weak payroll. We were all rooting for a weak payroll because we want the Fed to cut and hurry up and catch up with market rates. Market rates, of course, have come down dramatically this week. Of course, they spiked, long bonds spiked early in the week. But, we're going to get a rate cut. I guess the only question next week is inflation. Now, PPI, I'm sure, will be fine. The month before it wasn't because of higher wholesale diesel costs. That was a freak thing, mostly due to the West Coast. And, I spent a lot of time in California. They want green diesel out there. They don't like diesel from oil. So it's very complicated. They're shutting a couple of refineries down. So that's California's problem, but it showed up in the numbers. And then, of course, the CPI, we just hope and pray that all the weak real estate and everything finally shows up in owner's equivalent rent, even though it only shows up in rentals. But there is a glut of rentals, and hopefully we'll get some relief, and we'll be boarding on deflation because we've got falling crude oil prices.
I want to hit on the data, specifically the BLS data. We did hear from Commerce Secretary Howard Lutnick on Bloomberg Surveillance earlier today. And a reminder, he runs commerce, not so he's not running labor here. But he did weigh in on the data. He said Donald Trump needs to rely on the numbers. America needs to rely on the numbers. We need accurate numbers coming from BLS. Do we have accurate numbers from BLS?
Not when they do the wild seasonal adjustments. I mean, I think the worst month is January, where they automatically increased it 600,000 for seasonal adjustment. I hope they're going to stop doing that because that was, the holiday shopping and all that stuff. So I really hope they start just giving us the real numbers, not the seasonally adjusted numbers.
But do you have any reason to believe that the numbers that are provided to us by the government right now when it comes to non-farm payrolls in this country are incorrect in some way, that they weren't during a previous administration, as has been alleged?
I don't think it has anything to do with administrations. I think it has to do with the seasonal adjustments. And I think we just have to have fewer seasonal adjustments and then we'll go on. But yeah, I mean, I remember when the June payroll came out, we were suspicious because they were all teaching jobs, but teachers get laid off in the summer months. Maybe it was just a high number, but we were all suspicious of it. Like, no, that's not right. Those people get laid off for a couple months. So that's the kind of thing that freaks us out. We just want raw data. We get it from ADP. I don't know why we can't get it from the Labor Department.
Hey, one of the things I want to ask you, because you think it's already the Fed has been too late in terms of cutting rates, and you talk about what we're seeing in the labor market. Having said that, at the end of the month, Bloomberg reporting, others, how U.S. consumer spending rose in July by the most in 4 months. And so we were seeing resilient demand still among consumers in the face of stubborn inflation. And then there's the concern that the president's tariffs, that is ultimately going to impact something. It's either going to be Americans paying more for things or companies continuing to kind of eat it, and that's going to buy into, kind of eat into their earnings. So I'm just curious how you factor that in, the resiliency that we've seen in consumers, and that maybe the economy isn't as bad as everybody thinks.
No, it's not as bad as everybody thinks, but there's no doubt that the trade numbers are distorting the GDP numbers. And we got to get rid of those distortions. Obviously, we had a preliminary trade number this week that's going to impact GDP and to the downside, actually. So I just think that the dollar should be appreciating here sooner than later. We hope the dollar's appreciation is going to largely offset the baseline 10% tariffs. As far as the reciprocal tit-for-tat tariffs, there's no doubt that they're still haggling.
How's the dollar going to appreciate, Louis, if we're cutting rates?
Because we're the last to cut. Europe's got cut 8 times last I looked. The other thing is America's not shrinking like Northern Europe is or Asia is because of a lack of household formation. Japan has the highest birth rate in Asia, and they're still shrinking, okay? And so we're still pro-family in the South. We're still pro-family in the Mountain West. We're still younger than everybody else, and we do assimilate our immigrants. I realize that President Trump wants, the legal ones. The raid on the battery factory, I think, is pretty controversial. Those people were working. You think they could just get extensions. So, I think, it creates an interesting tone. But the bottom line is we assimilate immigrants in America, and we welcome them. We need them.
Yeah.
So we're just going to grow faster than everybody else, but our rates are going to be higher than they are in Europe, and we're the oasis. You don't want to go to China. I mean, my goodness, the rates are below Japan, and they're going to have a currency devaluation soon. All right. So, we're the place.
We're going to wrap it up on that one. All right, Louis, thanks so much. Louis Navellier, Chairman, Founder, CIO of Navellier & Associates, joining us from Florida.
This is the Bloomberg Businessweek Daily podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.